All right, welcome to The Explainer. Today, we're going to demystify the US stock market. It's a world that can feel pretty intimidating, but I promise, by the end of this, you'll get the core ideas that make it all tick. So, you've heard it a million times, right? On the news, they say the market is up. But what does that even mean? What is the market, and how can this gigantic, complex thing be summed up so simply? Let's unpack the reality behind that headline. To really get a handle on that huge question, we've got to start with the basics. I'm talking about the single most important piece of the entire puzzle, the stock itself. And this right here is the absolute core idea. A stock isn't just some number blinking on a screen. Nope, it's a share. When you buy a stock, you are literally buying a tiny piece of that company. You become a part owner.
So why on earth would a company sell off pieces of itself? Well, it all comes down to money, what the pros call capital. Through something called an initial public offering, or IPO, a company puts these ownership slices up for sale to the public for the very first time. And in return, they get this huge injection of cash to fund everything from new research to global expansion.
All right, so companies are selling these little slices of ownership, but where do you actually, buy and sell them? Well, that's where this giant marketplace comes in.
First things first, you got to forget that image of a single building with a bunch of people shouting at each other. The stock market today, it's a massive, interconnected electronic network. It's a whole system of exchanges that are all regulated to make sure trading happens in a fair and orderly way.
And here in the US, there are two main arenas that really dominate the scene. First, you've got the New York Stock Exchange, the NYSE. That's the iconic one you always see in the movies. And then there's the NASDAQ, which is newer, completely electronic, and it's pretty much famous for being the home of all the biggest tech giants.
So how do you get in on the action? Well, you don't just walk onto the floor of the NYSE. Instead, you use a broker. Think of companies like Fidelity or Schwab or Robinhood. They give you the platform, the app where you can place your buy and sell orders. They're basically the middleman that executes those trades on the big exchanges for you.
Okay, this brings us to the million-dollar question. What actually makes these prices bounce around all day? Well, it all boils down to one of the most basic, powerful ideas in all of economics.
Seriously, it's that simple. Let's say a company announces some amazing news, a breakthrough product, or record-breaking profits. Suddenly, way more people want to own a piece of that company. And that surge in demand from buyers, it almost always pushes the stock price up. And yep, you guessed it, the exact opposite is true too. If a company gets hit with bad news, or people just start worrying about its future, a ton of owners might try to sell their shares all at once. You get this flood of supply, with way more sellers than buyers, and that's what drives the price down.
Okay, let's circle all the way back to our original question. With millions of stocks zigging and zagging every single second, how could anyone possibly keep track of it all? How do we know if the market, this giant messy thing, is having a good day or a bad day?
Well, the answer, believe it or not, often boils down to this one magic number, 500. And no, that's not the total number of companies out there. It's a hand-picked group that acts as a super powerful barometer for the entire US economy.
This is what we call a market index. The S&P 500, for instance, is like a big shopping basket filled with the stocks of 500 of the largest companies in the US. So instead of trying to track thousands of individual stocks, we can just look at the average performance of this one basket to get a really reliable snapshot of how the market is doing as a whole.
And hey, while the S&P 500 is definitely the one you'll hear about most, it's not the only game in town. There's also the Dow Jones, which only tracks 30 huge established companies. Think of them as the blue chips. And then there's the NASDAQ composite, which is super heavy on the tech sector. That's why so many people see the S&P 500 as the best gauge. It's just so much broader.
Okay, so we know prices are all about supply and demand, and we measure the market's health with these indexes. But what are the big picture forces that cause that supply and demand to shift in the first place? What's really moving the needle?
Right. It's never just one simple thing. A stock's price is, of course, tied to how well the actual company is doing. Their earnings and all that. But it's also at the mercy of these huge forces, like the overall health of the economy, big trends happening in its industry, and something a little fuzzier, the collective mood of all the investors out there.
Yeah, this collective mood is such a big deal, it's got its own famous mascots. A bull market, that's when everyone's feeling optimistic. Investors believe prices are going to keep charging ahead. On the flip side, a bear market is all about pessimism. Fear starts to take over, and investors expect prices to hibernate or, well, fall.
So when you strip away all the jargon and the complexity, this is what the stock market really is. It's a giant forward-looking machine. It's constantly crunching the numbers on not just how much a company is worth today, but our collective belief, our bet on what it's going to be worth in the future.
Look, understanding these basics is a huge deal. It's really empowering. It transforms the market from this big, scary mystery into a system you can actually understand. A system that's all about ownership, fueled by our own beliefs, and filled with both risk and opportunity. So the next time you hear someone say the market is up, you'll know exactly what they're talking about.